I'm just trying to figure out why the market is so hot, if you can explain that to me. Because the environment during the pandemic, I can see how the stay-at-home plays would be very, people want to get into those things like Snowflake, but you couldn't bring a cruise line public now, couldn't you? You couldn't bring a travel-related or a lodging company, maybe, but there's Airbnb. What's doing it? Why is it hot right now? Is it all the cheap money?
Well, obviously, some of it is that interest rates are really low, so it very much favors growth companies. But I think you have to start with investors and returns. So when investors are making money on the companies that are already public, and you can see that in our IPO index and the ETF that we run, the returns are, when they're very good for investors in this space, not just on the IPO, but holding these kinds of companies, then the market opens up for issuance. Those investors are saying, okay, they get comfortable, we'll look at new IPOs. So we've gotten to a very strong point in returns ever since March. And the IPO window is just opened. We're seeing so much issuance, almost in some ways in these last couple of months, as much as we've seen during the internet bubble.
I mean, almost, is it record issuance, Kathleen? And it's going to continue, isn't it? Can you give us an outline of what to expect in coming months? Sure.
You want to make sure the returns look good. So that's first and foremost. You have the election, and a lot of companies are going to hold off. They'll be hesitant to do a deal around the election. So we're going to get to a little typical soft spot in the market. But if we're continuing to see these strong returns, we expect this year to finish up being certainly the best year since 2014, where Alibaba, that was the year Alibaba went public. And in terms of just the head of steam, I would say we're starting to look like the activity we've seen in 99, 2000.
Is it fair the way that we just looked at the way things work out? So certain preferred clients of the big banks and the underwriters, when I was in that business, I couldn't even get 100 shares most of the time. Maybe you could. But so certain well-heeled special people get in on the opening, and then the general public, you saw, they're down on every one of them. Is that a flaw in the whole system, or are things proceeding the way they're supposed to in capitalism?
Well, I think you have to, there's two parts to this market. If you're an institutional investor, and these days, it's a very small group of institutional investors that are getting shares on the IPO. So then the rest is what happens after the IPO starts trading. And you can't just look at the first day pop, because if you look at Snowflake, you just can't possibly, if you have any fundamental thinking, you wouldn't chase Snowflake, I don't think. But these stocks find their way into portfolios at the valuations that make sense to the market, which is why we put together this index, the ETF. Because if you buy the S&P 500, you're not getting ownership of these names. It took the S&P 2 years to include Facebook in that index. So what we've done is we've put together the new companies so that you can, and not on the IPO, these are the returns of the category of newly public companies. Our number one holding is Zoom. Now, who would have thought when Zoom went public a year and a half ago that it would be the company it is today? So a lot of these are hard to call. Certainly valuation comes into it. These companies like Snowflake are going to have to really beat investor expectations to justify. Snowflake today is trading at 200 times sales. I don't think I'm going to live long enough to see the sales get close enough to justifying that valuation. So the sales for Snowflake are going to have to be super. We're going to have to see some really good reporting coming out of Snowflake to justify where it's trading. On the other hand, there are other IPOs. One came out this week called Pactiv. It's a packaging company for the food service industry. It's a broken IPO already. It trades at 8 times EBITDA, 8 times operating cash flow, below any of its peers in the packaging group. So it's not like you can't look at these, but regular investors are not going to get shares of the IPO. They're going to have to figure out when to buy in the aftermarket, and that's why we put together this product. It's easy then for investors to own a basket of these, and it kind of tamps down the risk of having failures. And also, this product emphasizes the very, very large IPOs, which tend to be the less risky ones in the long run. So the larger ones tend to be better and less volatile.